Good morning. I'd like to call to order the meeting of the Budget and Finance Committee, and we have established a quorum with all members present. The first order of business is our minutes from October 6th, and I do have one change that I want to add. Under item 3.06, it should say the committee found the spreadsheet. Does anyone else on the committee have any changes to make? Hearing none, we will approve the minutes as amended. Now I will call on CFO Pete Finelli to review our September 2020 financials. Thank you.
Good morning, everybody. We found that in the previous sessions that the income statement up on the board was hard for people to read, so what you have been delivered and as part of the agenda attachments is a summary of the items within the income statement, and I'll try to go briefly through those without spending too much time on any one item, but at the end you certainly can ask me anything about them. So in the current year, for the current month only, our budgeting was actually pretty solid because on operating revenues we were only down $4,000 to the budget, and on operating expenses we were favorable by $9,000. So in the millions of dollars that run through there, we're lucky to be within a very narrow band. The tail on both the year-to-date and the September actual for revenues is pretty much the same. We're seeing the strength of the rounds played out in golf showing up in revenue growth over the budget. Ancillary revenues, we're seeing a lot more cart rentals, range balls. That in the current month was $33,000 up. Where we are seeing declines, of course, is where we're restricted on access for special events and sports pavilion. We were down 27 on that. The merchandise and food, expectedly, when the pro shops are minimized, they're down 11 grand collectively. And then just one singular entry in other income this month. We had in 2018 or 1920 budget for the Echo Mesa office to be considered as a expansion to accommodate the golf maintenance guys over at Echo Mesa. And there were expenses that were made on that in the prior year, and when that project now is completely extinguished from any consideration within the capital budget, we are we did a write-down of that, and that occurred in the current month at 27 grand. Moving to the operating expenses, we've had shortfalls in our staffing and mostly in some of the facilities as well as landscaping and golf maintenance. And that proved to be a favorable variance of $70,000. Utilities with some of the facility closures, and quite bluntly, I think some of the efforts that have been made in prior years for LED lighting changes are starting to bear fruit. Repair and maintenance is a very, very volatile number, so it can be up for 50 grand or down any given month. This particular month, it was favorable by 23,000. Landscape maintenance is an interesting one because I think Bill has asked Todd Patty in other sessions, how many pounds of seed do we buy? And the answer is, well into the 300,000+. And so the seed is all ordered at one time, but in the budget process, it was anticipated that the seed would be distributed at the 3 or 4 closed courses in September and then the other 3 in October. But that's not how accounting works when the seed was all delivered and we have to make the expense all in 1 month. So we should see some benefit in October with having some seed budget, but no tangible expense to accommodate that. The equipment is, generally speaking, tries to be put into the time periods where the managers are expecting to be delivering things such as umbrellas and all kinds of smaller non-capital equipment, computers. We just don't know exactly when those are going to be delivered, and favorable by 25 on that. And then lastly, I know Johnson's over here, does a great job with our audio visual, great hire. But the budget anticipated that there was going to be some effort done over at Palm Ridge to bring the whole audio visual system up to speed. So this is a one-time, I think 15,000 of that 24,000 favorable was with the anticipation of that. So it's been a great arrival of Johnson. And then the rest are all pretty material on the 25,000. Moving to capital related, the unrealized change in the Vanguard and JP Morgan funds was down in the month of September, 391. APF fees continue to be strong by 35,000. We had a $20,000 budgeted for some assets to be that had a net present value still to be written off when the completion of the project occurred. But some of those have been delayed by the COVID impact. On the positive side, we did have 20,000 of trade-in value for some vehicles, and since they had no book value, the trade-in value is booked as a gain on the sale. And depreciation is running favorably, mostly for the reasons I mentioned earlier, that there are delays in some of the assets coming on board, especially the deferred 1.8 million that we have done. So overall, September, as I mentioned, the operating in revenue over expenses is 5,000 favorable to the budget. The capital related was down by the 279, so overall 274 negative variance on the income statement. Moving to year-to-date real briefly. I won't go into as much detail because, as I said earlier, most of these run parallel to it. But as we said before, golf revenues, ancillaries are up, sports and pavilion and merchandise down. And that's on the revenues. On the operating expenses, same kind of thing. We've been running short on wages, utilities, R&M. And of course, the seed impact that I talked about should come back into balance at the end of October. And the equipment timing has been favorably, and also all other, which is legal, interest, taxes, supplies, all of those have been running below. And capital related, unrealized gains are, it says unrealized losses, that's an error. That's unrealized gains of 804,000. APFs also, as we said, were strong. The depreciation and gain are all favorable. So at the very end of all of this, operating income is favorable 541,000 to the budget. Capital rated is 950 favorable for a 1.491 thousand favorable variance against the budget. Real briefly, against prior year, the revenues are 116 favorable, mostly in membership and golf. And expenses, despite minimum wage increases and other things, were actually down 43,000 for a favorable operating variance of 159,000. Capital related overall was up 676 against prior year, with 620 of that being the unrealized gains component. So overall, 835,000 ahead of prior year. So that was just me rattling it off. Sorry, my apologies. So that concludes. Any question, John?
Thank you for a very succinct and good presentation of the financials. This is just a question to make sure that everybody understands this the same way. and it has to do with the unrealized gains. I am assuming that this is a mark-to-market evaluation, and it's done every month, and there are no transactions involved.
Correct.
Can you just confirm that and just make sure that everybody has a good understanding of that line item? It might come up and be useful later in this meeting.
The unrealized gains is exactly what you just said, that the market valuation on August 31st as compared to August or September 30th is the unrealized. There are occasions when it moves up to realized, and that's generally happens when there are rebalancings happening. For example, back in March of last year, when they sold out the bonds and bought the equities to rebalance it back, the valuation of a instrument being actually executed and cashed out, then it moves up out of unrealized into realized. But we're a nonprofit, non-taxable entity. It just, all that means is the valuation was in instruments that were, redeemed versus just still holdings.
Anyone else have any questions? Lou?
I have two. Number one, this document is published, and it's a heck of a lot of money. There may be, could there be more detail? Maybe in parentheses under that this is XYZ, September versus October capital fund holdings. May make it clearer to the reader and therefore eliminate a question.
Make sure I'm hearing that right. Are you talking the variance or defining what's in the item, just so I can do better at it?
On the summary of revenue and expenses, capital related down 279, unrealized losses down 391. Sort of a generic unrealized losses. Well, it's a pretty significant amount, so maybe we should define it a little better. I'm looking at the slide.
So actually, we do have that. And Katie, do I have the presentation
Maybe in the next one?
on the attached agenda? So why don't we go there for a second? Yes, thank you.
Is it
Yeah,
in the
I see the
footnotes?
financial statement as well, but if we're publishing both documents, might it make it a little easier for the,
Scroll down on that. Keep going. Keep going.
So our,
It's in the footnotes, right?
so right there, right there perfectly. One more up a little bit, Katie. Nope, sorry, thank you. So this is where the unrealized occur. And this, of course, everything's on a year-to-date. But this is page, sorry, I think it's 6 of the financial packet. And on a year-to-date basis, which I know you're focusing on the 391, but year-to-date, we do remain up 804,000.
well, maybe we should have an asterisk to say, see details, such and such a document.
Sure.
It's a significant amount of money. I may be drilling down too far, but if I were reading the document, I'd say, that's a heck of a lot of money. It's significant. The second issue that I'm in agreement with the rec center's position that we will not in any way change our recreation center dues. However, if you look at the last slide, once again, it's a significant amount of money. Do people look at that and raise questions? We just should be prepared to have an answer.
Well, I appreciate that it was passed, and on a year-to-date basis, 3.593 actual, 3.593 budget. We're pretty proud of that.
Okay,
That we
I'm
were,
just saying, when people
pretty-
look at I don't think people read the detail. When they look at this number, they're going to say, well,
Fair
be
enough.
prepared for an answer.
All of those, a lot of those questions are right after the income statement, are all these explanations, and a lot of times they'll answer those questions that are, and quite bluntly, you raised the point, is anytime there's a material variance. I asked my staff to produce the explanation so that it's I as the CFO and them as the production give ample answer.
Thank you.
I might interject, Lou, that last spring, the budget voted to hold back, I believe it was 1.8 million, was it, in capital? And that will be discussed again, I believe, in January as to whether or not we're going to release that. We were trying to keep expenditures down, and so hopefully we will not have to avoid doing those things that need to be done, but have been abated for now. Am I correct?
Yeah, but thank you. I will take that advice and make some more clarity for sure. Thank you.
Anyone else on the committee have any comments, questions?
Thank you. Thank you.
Hearing
I have one additional
Go right ahead.
question. And again, just to kind of level the information across the table, when I read the financial statement notes, which I think are quite good and quite explanatory, they help me a lot. On the member dues and fees, I was struck by the feeling that from an ownership point of view, the community seems to be weathering any fallout from the pandemic quite well. Ownership appears to be normal, but renters and renting is down, i.e. The tenant cards and so forth. So I jumped to a conclusion, and I would like some people maybe to rein me back in, and that is that we could see some fall off in historic or seasonal revenue coming into the winter months. It would appear that we're not going to have as many snowbirds, perhaps.
Excellent, John.
And just a short, I mean, I don't want to make a big deal out of this, but I'm kind of looking ahead, and it sort of plays into Chairman Brown's remark about the capital that we're holding back. I'm not ready to relax and say the victory has been won here on this.
100% agree. I'll give you three numbers that are going to be likely degradatory to the income statement that have not reared their heads with as much voraciousness as we think is going to happen. The three are special events. The budget calls for almost $270,000 of net revenues to be captured by the association for a particular event. If you capture 10,000 of revenue, pay 8, then we push 2. So that's going to be very much likely to be not met this year. Second one of materiality is guest fees. Well, you mentioned the tenant fees. That one doesn't scare me as much as the guest fees. In March and April and February, those are well into the $50,000, $40,000 range. It's a flip a coin right now if we're going to be able to open. I certainly hope we do. But that aggregates to about $280,000 annually comes off guest fees. We've collected $100 year to date. So the last one is the sports pavilion, bowling. It carries approximately 900, or a little bit short of that, 800,000 of revenues. Barry's done well to get it reopened and keep safety, but he's running at a best case scenario of 50, maybe 60% clip. So you can pretty much count that 300,000-400,000 of bowling revenues are not going to come to fruition. So yes, we're 3 months into it. Yes, we have built a favorable variance. I hope one of the offsets will continue to be the things that are occurring in golf, but we don't rely on that. And as we've made a proclamation to the board that you are referencing, we are not going to proceed with those deferred capital items until more understanding of what's in front of us on the income statement is clear.
Thank you.
Thank you, Pete. Hearing no other questions, we'll move on.
Ann? Kathy?
Yes, I'm sorry,
I
Kathy.
actually like the question and I like the answer. And the kind of the three categories, it might be beneficial for us to see as every time we meet, just kind of the status of that, because I think that does put that context together.
Thank
If
you.
that's
Pete,
possible.
would that be possible to,
It is. It is, I don't want to belabor it, almost all of those. I take that back. Special events is all by itself, so we'll be able to see it.
Yeah, but just a
Sports
simple one-page.
bowling will be all by itself, and the
I'm
only
just
one
looking for a
buried within it
one-page,
is guest fees.
simple.
so, yeah.
yeah,
Thanks.
just
So I will
something
definitely do
quick and
that.
easy
Thank
if
you.
we can. I'm next going to call on our general manager, Bill Schwind, to give us a presentation on the presentation on the preservation of principle, and this is going to flow into the next two items on our agenda, which will be Q&A with our Vanguard representative, and then some reviews of financial policies 04 and 12. So Bill, I'll turn it over to you.
Thank you, Chairman Brown, and good morning, everyone. I just want to give a little bit of a presentation as to where we've come from, basically from one lap around the track to where we are today. Pete and his staff are getting ready to distribute all of our budget information out to individual departments to put their operating budgets together, as well as kind of any kind of new requests from clubs and those types of things that kind of fall in line with our repair and replacement program that we've developed along the way, as well as our reserve fund. So a couple of things kind of jumped up at us that as we move forward in this scenario, and we just want to shed a little light on it, get some feedback from the B&F committee, as well as perhaps a recommendation on to our governing board as to how we move forward and how we deal with some of these things that really have kind of presented themselves as a little bit of a question, potential problem for us when it comes to consistency and following policy. So as you well know, when we did the 2021 budget, we were rolling along and putting everything together, and at about the time we were kind of presenting to governing board and various committees and whatnot, COVID struck. And so there was an issue at hand, and we had to kind of readjust a lot of the things that we were doing. But in doing that, we realized that the way currently we have a lot of our reserve funds invested, they're exposed funds. Invested in equities and that type of thing. And when you play by that game, you tend to have a risk of deferring projects depending on the market and depending on where we are presently with our principal balance when it comes to reserve funds. So Pete has put together, move forward, thank you, Katie. Pete's put together, as you well know, a working scenario relative to a reserve study that we've done that has thousands of line items in it spread out over the next 30 years as to what we know we need to fix and when. It's a great guideline. We have paid professionals that do the analyticals on that every year to make sure the numbers that we're playing with are correct. And then the governing board obviously has a determination in how far they'd like to see that floor drop before they basically call time out. And right now, that's a 40%, a minimum or a maximum of a 40% fully funded balance when it comes to our reserve fund. So any kind of shift in kind of equities or our balance really affects the way we budget. And based on what we have in front of us here as far as our policy statement basically specifies that the specific goal shall target the preservation of capital, liquidity, and rate of return in a specific order. And so the number one objective really in our policy that we're trying to focus on is the preservation of capital. Again, 2.1.1 in the financial policy basically is our foremost objective in our investment portfolio is preservation. So when it comes to our reserve funding and the policy of our fund, the association standard for an acceptable reserve is set between 40 and 100% of a fully funded balance. A couple of years ago, upon my arrival here, about a year and a half ago really, That was in the high 60s, mid 60s, as far as that goes. But again, having a consultant on board with Pete's eyes coming on board about a year ago, looking at some scenarios and consulting with staff, we found that there were several items not existing in our reserve study that really needed to be there. And the big hitters were irrigation repair on golf courses, turf line, or excuse me, lake line mitigation as far as erosion control and those types of things. They were planned by our golfing staff, but they were not formalized in our reserve study. So including those into our document, obviously, we dropped a serious amount when it came to fully funded balance percentages. So we feel we have a very tight plan as we exist today. And so hence, the governing board made some control measures and went along the route and adjusted the acceptable percentages between 40 and 100%. So Association Reserves is our paid consultant that provides the information for us. The CFO and our Treasury representative here, which is Ms. Brown, have control measures that basically we are reviewed by independent auditors, and we protect the investment portfolios from fraud and poor management. Now, I just want to say the two words at the bottom of the end of that sentence when it came to poor management tend to shine a light on your general manager. That be me. And so when it comes to making sure we're doing the right thing, I just want to make sure that the governing board and particularly here today, the Budget and Finance Committee are just educated as to what we're doing, and your recommendations and the governing board's policy decisions are what we abide by. All we're trying to do here today is educate and shine a little light on the situation. So when it comes to the reserve fund and budget preparations, really, it's a form of risk management. We do the analyzation, we monitor, we control, and we identify issues that we're going to present to you today. So what we've kind of uncovered, really, in our investment policy, we talk about portfolio protection. I mentioned that. That's your policy FI 12. I think we'll be dealing with that a little later today, but really the crux of that scenario there is a ranked order of what's important, and the number one scenario there is protecting our principal. DJ Vlamming is our associate with Association Reserves. Basically, their organization oversees 25,000 organizations, from HOAs to municipal standards on risk to planned communities such as ourselves, okay? In listening to DJ and at his presentation that he made at our biannual meeting a few months ago, when it was presented to him that we were invested in equities, he said that's pretty rare for an association, or any associations really, that his firm manages. It's risk and exposure to your principal. He used the word startled, which kind of woke me up. And as we started to talk and think about that, you know, where are we and where are we going? Some states, based on conversation with our legal team, it's understood that they don't even allow that type of activity and investments in those types of funds. So essentially, we've got exposure to our principal. It's a risk to our R&R funding, and the other option that we've got ahead of us is long-range planning that we invest with Vanguard, but we also have annual need. So I understand all the concept of long-range planning, whether it's 10, 30-year plan, great, invest away, but we still stand here at the ocean front, and we deal with the breaking waves. You know, I can look out on that ocean and it looks flat. It looks pretty tempting and very, very nice. But at times when we're standing here at the ocean, these waves can get pretty big and volatile. So when we look at the industry standards, can you go back once, Katie? Thank you. The industry standard in investments, the vast majority, over 95% of these corporations like us do not invest the way we currently do. And so similar situations, when you look at Sun City and Sun City Grand, they are not exposing their principal. They do not invest in equities. And there are a lot of Sun City communities across the United States, very, very similar behaviors. So moving forward, Here are the 4 reserve rules, all right? We know expenses are inevitable. We have to fix things, and new things come up. The board's responsible for those approvals and getting funding and making sure things are carried out. Delays or referrals usually can get expensive, and homeowners always get stuck paying the bills. So a while ago, the policy was changed, allowing equity investments to happen. And basically, a decision was made to have a breakdown of 60% bonds and 40% equities managed by the professionals at Vanguard. And since that time, the tailwinds of a bull market have been very, very favorable, and congratulations to any and all who have been responsible for those investments. As you can see, since that took place, we've jumped incredibly. A lot of it due to the Vanguard funds, but there has also been increases in fees, be it APF, increases in cash deposits, as well as CDs and the like. So collectively, we've done very, very well for ourselves over the last couple of years, particularly. Enter COVID. So we were staring at a pretty healthy budget come December, come January of last year, and then we took a pretty big decline, right? Over $4 million in 30 days. 3.6 of that was representative in equities and about 600 grand in the bond market. So our fully funded balance declined to the mid 40% range. Moving on. We were flirting with a proposed $13 million capital budget at that time. It had golf course irrigation, it had other various projects that were being brought forward that basically at that point hit the wall. So refer and defer based on the drop in the reserve fund. And as Ann mentioned earlier today, the 1.8 million is being deferred until January of some what we feel are essential projects in this year's budget that are being placed on hold. The big shooters in that particular market is the parking lot at Trail Ridge, that is Palm Ridge, I'm sorry, that is growing alligator skin as we speak. Not a good site, so that parking lot really needs to be worked on. That's about a $900,000 project, and we are happily, unfortunately with the COVID thing, we've taken a bit of a hit, but we are happily the busiest bowling alley in the state of Arizona. Most lineage that produces here is right down the block here at our facility, and we have a scoring system that is basically upside down and doesn't work every other day. Not a good site. And so that project has been deferred, and there are a lot of unhappy bowlers, but as of right now, we're not seeing too many of them. But if the doors were open and things were going strongly, they'd be at your doors, I promise you, kicking them in, because we have a serious problem in that building that needs to be fixed, but being deferred. So now it comes the uncertainty of the market. You know, I can't predict, and basically if I go to Vegas, you know, it's luck more than anything else. But federal stimulus that has helped bring us out of that V-neck curve when it came to last March. There's a lot of money, $3.5 trillion in the CARES Act of federal stimulus that has come our way. The housing and inflation markets are what they are. You all see the news. I know you're there. The unemployment rate nationally is ridiculous. And, you know, is there a looming correction involved in adjusting the market? I can't predict that. I'm not in that game. But I do know that any kind of correction to those types of funds, be it the equity funds or the bond funds, will affect our principal. A 20% correction slams us to that 40% floor, and if I'm coming to you in March looking for capital items, doors are locked. What are we going to do? That's the dilemma that I'm trying to present to you today. We don't know. I can't predict that, but there are projects that I do know we need to fund. But if I've got a floor that we're up against there's really not a lot of options for us to get that money available, which we do have. But again, it's just a matter of policy and how we spend and how we operate. So, roll, Kate. Thank you. Enter Vanguard. I spoke highly of them and continue to do so. They've done a wonderful job investing the money up until this point. But again, it's a 20 to 30-year horizon. That's their market. We've talked internally with our financial staff. If we want to stay and if the governing board opts and the B&F committee recommends that we stay within this type of investment market, is there a possibility that we could adjust our ratios for a little more preservation of principal? But as of right now, the governing board and the policy has basically initiated a 60-40 ratio that has not been adjusted in 5 years. So there it sits. And so, those are certainly options that we can entertain and talk about. Data has indicated that we've seen large declines over a period of time. The market does bounce back, but, it typically does take time. And, if time is our measurement and rate of return is our primary cat here, then, preservation of principal needs to be adjusted within our policy as to maybe not our top priority. But again, when it comes to repair and replacements, that's the call we're trying to make come budget time, is to make sure that we're taking care of the association and maybe get involved in less volatile funding. So again, as far as asset management, the board's primary goal should be preservation of the association's reserves. We get that. It's spelled out in the policy that way. R&Rs basically should not be conditional upon Wall Street. They should be conditional upon the funding that we have available to us and the condition of our facilities. Stocks and non-government bonds are considered high risk. Treasury monies are medium risk, and bank savings are very low risk with low return. We get that. Most boards interpret their fiduciary responsibilities to mean they got to limit their investments to those that allow growth but don't jeopardize the principal. Okay? So, yeah, these are standbys. These are kind of boring investments. I get it. Savings accounts, CDs, and commercial paper, but they're fixed and your balance stays protected. So, discussion points today after, we could potentially alter our investment ratios. We can adjust APF fees. I believe, a $100 increase in an APF fee, for instance, will gain you $125,000. Good. Have the newbies pay for it. I mean, there are ways to capture revenue that are just not fee-related to owner members here. There are other ways and avenues that we've kind of identified that could possibly help us out. The majority of the industry that we are in, basically, with fiduciary responsibilities of boards and those types of things, is the preservation of principal. Board history, there's been opportunities in the past, in the mid-'90s, where they were doing some investing, that type of thing, that didn't go well. And so, again, that's why the policies are kind of in place as they are now. And again, the goal of preservation of principal and avoid special interest assessments really is something that we kind of list out there as our number one priority. So, talked about it a little bit. A 20% reduction in equities, be it a market reduction of some kind, will put us very, very close to the floor when it comes to putting forward our upcoming budget. So we're very cognizant of that. I can't tell you where we're going to be in March when when the rubber hits the road, so to speak, when the budget is trying to get approved. We've got a reserve study that Pete touts as when he comes to that 40% or 50% load as to where we're currently at, but that changes daily. I mean, there's a big variable in there, and that's called our principal. And so every day the elevator stops at a different floor. So I can't tell you how much money we have today. The reserve study says one thing, but the reality is, it's market driven. So independently, talk to a CPA, ask them the question, companies investing in growth, so should your HOA or your community association invest as well? Short answer, no. Their response, You shouldn't take risk with other people's money. Moving on to companies that oversee condominiums and whatnot, same thing. 99% of the type of organizations invest only in CDs and money markets, none in equities. Why? It's other people's money. So I get it. I understand investing. I have a 25-year-old kid, and he's pretty aggressive, right? Different than me. But, he's got a little bit of time to make that up. So we do have a risk and reward program, but we also have a repair and replacement. And the way currently that the policy is written, it's a little bit, as we experienced last year, it's a little bit iffy when it comes to being able to move forward with a reserve plan in place with a variable. And so I believe that concludes my presentation. I did, and if there are any questions, I'd be happy to answer, and I did speak with our attorney based on any kind of liability that may exist between this board, the governing board, and decision-making and investing in these types of scenarios, and he has rendered a response that goes back all the way to 2012 when this subject was originally, I think, brought forward. And so it's pretty interesting to go back in time because here we are again, and another just went full circle. So, thank you.
Thank you, Bill. I'd like to ask the committee to put forth any questions that they might have of Bill and about this presentation. Kathy, do you have any?
I'd like to hear other comments.
Okay.
Because I'm new, so.
Come back to you, John.
Thank you. And as usual, I have some questions. I'm not sure that they can be answered in this setting, and I know that markets can react very quickly, so I don't want to be guilty of dragging this out into a full year study or anything like that. But I have two data points that I think would help me. One is I would love to find out a little more about the history of how we got to 60-40. I think that would be informative. And then the second data point, and Pete, don't cringe, I'm wondering if it's possible to tease out of that, let's say, approximate 27 million, how much of that we could designate as a result of the investment strategy versus straight 100% CD type of thing. My interest in that, and again, I know that could be a Herculean job, but there's a risk-reward factor here. There's a long-term, time is on our side kind of factor here, but I tend to build a little economic model, and I made an assumption last night after this very thought-provoking and well-written presentation. It really got me thinking seriously about this, and they weren't pleasant thoughts. To be honest, I was quite concerned when I finished reading this. But I said, okay, well, let's say that we've got $5 million out of that 27 is as a result of kind of an aggressive investment strategy. I took that amount of money and I divided it by 30,000 residents, and I got a pretty small number. The reward from what we're doing, I'd like to pin it down a little bit with some professional help here, but I don't think the reward we're getting is maybe as great as we might think it is versus the risk. I've taken up enough floor time, and you asked for questions, and my question is, Pete, can you do that? And easily either now or needs.
I'll throw a few facts out. The investment change from the heavy CDs and it gets a little confusing because all the funds were moved from CDs or cash all into Vanguard at one time. So I used the 2016 and 17 as my barometer, And the tailwinds, if you will, of realized and unrealized gains was about $3 million. The investment earnings on it, which is, I think, the key part answer to your question, is that was almost just under $2 million. In more recent years, and to start the discussion on the need to chase the return on investment, that to me was also one of the items that Vanguard initially said when we went in and started talking to them. What do you need the rate of return on in order to meet your goals? And so factually, to your point, $10 million approximately resides currently of our $28 million in equities. 60% or of the Vanguard funds, or $14 million, reside in bonds. And then just under $4 million resides in JP Morgan, which is in CDs or bonds as well. The circle back to your question was the yield. And on that equities, in recent years especially, it's been almost 550,000 to 600,000. So there is no question that when you're invested in dividend stocks, that 500 grand or 550 outweighs the 150, maybe 200,000 at best case scenario you're going to get by hold up in very conservative. So we use that 350 to 400,000, maybe even worst case scenario 500,000 gap to establish our what if. And so you guys have seen it, and I have the ability to demonstrate to you how changes in that what if model can produce a 5-year, a 1-year, or a 10-year alteration to the FFB. And that is the absolute guiding principle that we're proposing, or not, or discussing, educating today, is that 500,000 loss in year 1 equates to about a 3 to 4% impact at year 10. So I'm not disputing, and nobody's disputing, that it's going to, of course, decline. But it doesn't jeopardize hitting the 40% floor. And as Bill alluded to, this is just simply for discussion, there are other techniques of capturing reserve fund inputs. The one that a lot of people jump to is dues. Well, that's not necessarily the case. In fact, in my modeling, I use a 2.5% annual dues increase, and I still am able to hit the 50% or so 10-year FFB. I don't go aggressive on house sales. House sales were 1,200 now. Not saying we're going to always hit that, but historically, in the last 3-4 years, we've been exceeding that. And so I'm not using some pie-in-the-sky number to just... And then lastly, probably the most important part is I still equate $750,000 annually for new capital. And that component of 750 equates roughly to $7.5 million. I don't know in the current environment of too many items that we have on our horizon that are going to be of that dollar value that wouldn't necessarily fall under some of the covenants of who's going to fund it. And I know the expansion of last year is probably the worst example, because a lot of that was HOA responsibility globally, with a relatively modest amount of input by clubs and things like that. That's fine, but we have addressed that. And for the most part, going forward, it is expectation that new capital would likely be funded on the expectation that the clubs would have some input. And so circle back all the way to the 400 and 500,000 that you're chasing by exposing $10 million of your reserve funds to volatility. And if you're needing to chase the 500 grand, most of us would say, let's go after that. But we reside at 51%, 50%, as Bill said. Any given day, I can tell you that goes up or down by 1 or 2% on either side of it. But our comment would be, is your current policy had the exposure 6 months ago where you lost 4.2 million of that and started to approach the floor, it impacted the ability to fund the reserve. It impacted the FFB and created the deferral of 1.8 million. From this chair, at least, it seems like the need for that return is not necessarily consistent with the preservation of principle that is stated in your policy to be number one on the priority list.
I think what you said supports my contention. The reward is relatively small compared to the risk. Are we in agreement?
We're here to
using different
educate.
words?
We're here to educate, but I just a comment, this isn't some pie in the sky. We literally watched this occur last March. We saw the effect, every step of what your policies try to alert you to. But we are, as Bill said at the very beginning, we're educating, we'll follow the policies. It has had benefit, we'll be thankful for that. But at the same time, recognize that almost all of those gains in a 5-year period were extinguished in a 30-day period. So, you can tout the good side, but be careful of recognizing that we were lucky to have rebounded. I think Bill would say, it's not my opinion that we should be necessarily operating for our 30,000 members and deferring repair and replacement for those 30,000 people's on the back of the market. That's just an education statement.
John, my short answer is yes.
John, any more questions, comments?
No, thank you for allowing me to express those.
No, appreciate it. Terry, do you have anything you want to say?
No, John asked my question, okay.
Lisa?
No, I have nothing.
Harry?
My feelings is I think we've got to preserve the capital, and maybe something to look at would be every year X dollars of dues or dues increase. It might be a number of $2, $3, whatever, is directly to go into the capital preservation fund besides the profits at the end of the year, so that there is a return and people know what it is. And it's done because of the fact that it's got to grow to take care of the needs.
Briefly speak to that. Yes, your current policy, and I'm going to simplify this, $1.5 million has been the general target for the last 5 budgets and actual performance. Take that $1.5 million divided by 30,000 rough number of residents, and you get $50 annually indirectly is being asked to come out of the dues or the operating. So I'm going to make 2 comments. That $50 of the $497 currently, it's about 10%. Most HOAs are in the mid to upper teens when they're establishing their expense line. It varies. I mean, you can get some that have 2%, but there's some that are 25%. Our closest comparison, though, is Grand. They have a $1,600 annual dues. They dedicate $400 of that every year to R&R. That's 25%. So I would argue that the $50 indirectly coming into the R&R through the current mechanism is pretty low compared to either industry standards or our people right across the street from us.
Anything else, Harry? Luke?
What's your recommendation?
She answered my question. Really, we're shining light on this, I mean, our recommendation is to follow the policies that are set up by the governing board. Unfortunately, I mean, I don't want to take a left-hand turn. If you're asking Bill Schwinn outside as we're walking out to our car, I'll tell you what I think we should be doing. But as your general manager, I have to follow policy. And what we're here today trying to get a little answer on, as I reported back to our attorney to try to get a little bit of a clarification on this, we just have a little bit of a shift, I think, in what the policy says up front as far as our number one priority and goal, and back down a little farther into F12 is the kind of the outline of what's allowable as far as investments go. And what we're seeing and what we have seen over the last year didn't play real favorable to us due to the volatility of the market. And again, so preservation of principle is the name of this slide presentation, and that's kind of where I stand.
Thank you.
Kathy?
Yes, I do have a couple comments. First of all, I'm new, so I've been here a little over a year. I think we're a community that is heavy in facilities, I suspect. And with that comes that repair and maintenance. And if that starts to deteriorate, then you're not going to have as many people come into the community. So I think that capital reserve is critical. And being new, I know we've done the best we can, but can feel the struggle to try to even get ahead. So, and that is going to be critically important for this community. When I read the presentation at home, I wasn't so convinced on getting out of equities, but listening to the discussion, I am even more convinced that we should. The downside of that is when the market is really going well, the board will take on heavy criticism. But I want to go back to John's comment on the reward, and then listening to Pete, the 350 to the 450,000, that was actually the yield. And then that's even a smaller number, John, than you threw out there to begin with. It's not worth that. In my opinion, it's just not worth taking the risk of losing the amount of money that has been lost. I think the challenge will be continually educating the community as to why the change. And I think just some simple, I don't know how, well, I always say simple, it's not so simple, but ways of kind of bulleting out at least the thoughts on some of that change. I too agree with Harry. Harry, I think the comment on the owner's dues membership, it feels to me that's a small number listening to Pete. Of course, if that number goes up into the reserve, then of course then we have an operating issue as well. So trying to balance that as well. So I think that would be something that the board should consider looking at. My comment on Grand is 1,600 and then 400 into their reserve. They're quite a bit younger than we are, I think. And so it could be they're trying to build a reserve period. So for us, and a couple more comments here. I think the 40% floor in the reserve is scary. I think that's a low number. I'm not real comfortable with that number, but if we can build that up, I think that would be very good to do. Then I do have actually a question, and as you make this transition, and it's more of a, I don't have an answer, I'm not sure everybody has an answer, but how would you transition out of equities? How quickly would you do that before you see the change? And I'm not a financial expert in that, but I know there are kind of standard steps in transitioning. You wouldn't do it all at once. So I support principal preservation for sure. I support the move out of equities into a more conservative portfolio. I support more money into the reserves from the membership dues. And those are my comments.
Thank you very much. Pete, did you want to address her question of how do we transition from equities to index fund if that were to occur?
All, as attested by our Clifton Larson audit, all of our instruments are considered at face value right now, the value of the market, because they all have a less than 1 year liquidity. And quite bluntly, every one of them that we have can be redeemed tomorrow. So we currently already have the structure of CDs with JP Morgan. Vanguard very well may have instruments if we wanted to stay within their brokerage for putting it into safe. I'll have to check with Andy Maslick, our representative for Vanguard, to assure that they do have those, but I would be shocked if they don't, if we wanted to stay with them. Yeah, thank you. Thank you, Andy, I can hear you.
I just want to say a few more comments, Andrew, and then we will start with you. I appreciate the comments of this committee because I think they're very insightful. I think it shows that you all have done some homework on this and have paid good attention to this. As I mentioned earlier, this is going to flow into not only our Q&A with Andrew from Vanguard, but also to our policy reviews on 04 and 12, which, as we've seen, are not really in sync with each other, with the goals that we want to accomplish. So if there are no other questions from my committee on Bill's presentation, I'd like to open the floor to Andrew Maslick with Vanguard. Andrew, are you on the line? Can we get the sound turned up just a smidge, please?
Johnson, you want that? I'm sorry.
I'm asking to get the sound turned up here just a little bit. Andrew, could you say something?
Yeah.
That's better. Thank you, Johnson. I appreciate it. Well, let's go ahead and start with any questions that my committee may have. Lou, I'm going to start with you.
No questions.
No questions? Harry?
No questions.
Lisa? Terry?
Just, if we have $10 million in equities, is there like you said, does he have a plan or does he have an idea of how you would back out of that? Okay, thank you.
Thank you. John?
Excuse me. I'm looking for a little education on the types of investments that would come under the heading of preservation of capital. You know, at the extreme, we could put this into a tin can and bury it in the backyard and earn nothing. If you go to the extremes, sometimes it's enlightening. And at the other end of the spectrum, perhaps, would be something like putting 100% of funds that we don't need immediately into something like Ginnie Mae Fund or something like that. There's a whole gamut of those. And I'm just, if off the top of your head, Andrew, if you could help us with just some of the types of things that replace equities.
couple different fashions or a few different fashions. One obviously is the risk that any portfolio is exposed to, particularly invested in equity. Yeah, I think that's one of the reasons why early on the decision was made to create a 40% stock, 60% box of portfolios, kind of provides you certainly a degree of growth, but having a fund ballast. The other way I view risk is in particular in this environment where the expectation is that the Fed will remain pretty dovish for a long time. They just recently changed their strategy as it relates to inflation targets. And so the expectation is that they're going to stay low for quite a long time. So on the short end of the yield curve, I guess the one risk that I haven't heard today discussed is the ability or the risk of the portfolio to satisfy annual spend, and also grow or at least maintain an inflation-adjusted value. So that's the only other thing I would interject here in the conversation is that, in particular in this environment, not having a straight sight line to what spending needs you have, let's say, over the next 2, 3, 4 years, but CDs and money in the bank and being in that fashion is pretty de minimis at this point, and probably for the foreseeable future is the ability to allow that portfolio to grow to some degree, or at least keep pace with inflation, not just inflation as it relates to broad U.S. inflation, but specifically, the cost that you incur, as it relates to some of those objects or projects that you discussed, for example, irrigation and maintaining other facilities, that might be very different. The cost to maintain that might be very different than what national inflation is. It might go up at a faster pace or a slower pace, depending on what's happening in the region and that particular segment of the trade. So that's just something else I want to interject here. As it relates to any trade, you have really significant potential options. You may maintain the bond line, or outlook for bonds, broad bonds, over the next 10 years. We always look at this kind of in broad, longer terms, for good reason, is that for bonds, the range of likely outcomes is pretty muted. It's an understatement. Through our running of our major capital markets relationships with our group conversations over the next 10 years, this is ran in June most recently. Our expectation is 0.5% to 1.5% as a range for bonds. That gives you kind of an idea of, if you were just simply replicating the broad U.S. bond markets, history tells you 5.4% is kind of the norm or the average. We're expecting something significantly below that at 0.5% to 1.5%. That gives you kind of an idea. And that if you take even a more conservative stance, and we'll say CDs or something in a bank deposit like that, you probably lower that even further. So that's the only point I'd add. So option is you can maintain the existing bond lineup, or you can simply liquidate and then simply move to something quite a bit more conservative.
Did that answer your question?
It was insightful. Thank you for the comments, Andrew.
Okay. Kathy?
No, well, that was good answer, or good information. And obviously, we're giving up the ability to grow that reserve fund as ambitiously as we have done before. But that leads me back to Harry's comment about maybe owner-member portion of their dues going into the reserve fund, maybe to offset that, so that we can have that long-term growth. That will be critical, in my opinion.
Thank you, Kathy. And I think that's probably a discussion we need to have apart from this, but I think it's a good thing for us to have in the back of our minds as we go forward with budgeting and looking at next year. I do have one question for Andrew. I don't know if you were with Vanguard or you were part of the scenario when our funds were invested at the 40% equities in 2015, but do you know if Vanguard performed a risk assessment for this, for these funds, for the board, for how they were to invest? Or did you just take your direction from what we tell you?
I think I have an answer, but just to give you a full backdrop, I was within the group. I wasn't the primary point of contact or the investment consultant. So I took over a couple of years back, or a couple of years after that happened. Now, typically, and I kind of produce these, I refer to our Vanguard capital markets model, which is our kind of a analysis, and we also embed kind of a risk analysis as well. We kind of stress test the portfolio, and so typically what we do is we'll provide you with an array of potential outcomes on the upside and the downside at various different asset mixes. So, for example, at a 40% stock, 60 bond, we may compare that to something more conservative or more aggressive, and give you an idea not just what the expected return environment may be, but also what the likelihood for loss may be. And the way we kind of portray that is, the likelihood of experiencing a loss of X% in a given year. And I'll give you an example here, because I did load up your portfolio, if I could just, the joy of remote working. Give me 1 sec. Here we go. So just as an example, so your current makeup of the portfolio, this was the June running of the model. The greatest likely outcome over the next 10 years, annualized, this does not include inflation, it's nominal, at 3.78% as a return, and you have a range around there. So our thought would be is that over a 10-year period, there is a good likelihood you'd experience a return of, we'll say, 3.75% on the low end. So you look at like the range around median, we're more at 2.5%, kind of as a reasonable worst case scenario, and on the upper side, closer to 5%. But then when we look at the other metrics, so I'm going to pull up the risk analysis, and give me a second here as it loads up. So with your portfolio, in any given year out of the next 10 years, the likelihood of experiencing a loss of at least 10% or greater is about 22%. The likelihood of experiencing a loss in excess of 20% is less than 1%. So it gives you kind of an idea that there is a extremely low likelihood of experiencing what we call a severe loss, that in excess of 20% in a given year. If you talk about 10%, between 10 and 20, you move up to about 20, 22%. 15%, by the way, is under 5%. So the likelihood of experiencing a loss in any given year of the next 10 years is under 5%. So I think thinking back to 2015-16, when this was developed, this was probably considered, and we looked at the various components, and that yes, there is an exposure to downside, but we try to mitigate that. And the way you do that, and it's in most simplistic terms, is you tweak the bond exposure, so you continue to increase your bond exposure. As another point for conversation, so I've chatted with Pete on a number of occasions leading up to this, and I will say I think the group needs to do what it needs to do. It's not, I mean, it's kind of odd as that sounds. I mean, ultimately, if the decision is made that stocks are not the right place to be, that's the decision. I would encourage the group that in 5 years, if a whole new team is on the board, then obviously we want to make sure this is a consistent message and thought. So we're not, in 2015, we're going into equities, and then 2020 getting out, and 2025 getting back in, because that's something we wouldn't suggest any group doing. But in my conversations with Pete, we've kind of discussed a few different scenarios and paths you can take. One is status quo, you maintain where you're at. 2, you reduce your equity exposure, so you reduce the likelihood of a severe, loss, and so going from 40% stock, 60 bonds, you reduce it maybe to 30% stock, 70 bonds, or something else. The other option I chatted with Pete is we could introduce a new fund to the portfolio that is designed to mitigate volatility. So we have a a fund called the Vanguard Global Minimum Volatility Fund, which is designed to find stocks that have exhibited lower volatility historically. So the idea here is that you're still exposed to equities, but you're not going to participate as much as you would on the upside, with the expectation is you also won't participate as much on the downside. And then the last option, obviously, I think is what you've been talking about today, is you simply say, we're not comfortable with any equity exposure at all. We understand the environment we reside in today, that it's a pretty low return environment, but that's okay. We're still going to maybe bring us to where we need to be. And you simply just liquidate the portfolio and reallocate. Vanguard does have brokerage service, so you are able, if you decided to be outside of the managed relationship with me and my group, but you could always open up a Vanguard brokerage account, which does provide you the ability to buy brokered CDs. So you could divide this up amongst quite a few different bank issues CDs, so to ensure that you're fully covered federally.
And his options that he was giving us.
And those are part of the presentation that we've included, basically the stay the course scenario, or our lowering our equities, or investing in a less volatile, lower beta ratio that
Yes.
he explained to us and as we put this thing together.
And thank you, Andy, on reminding me about inflation. I think everybody, I should have brought it in there, but I do think most people understand, 0.5 is what I think we're getting at JP Morgan right now on our CDs, against an inflation, even though it's been running, roughly 2%. By policy of association reserves, the people who built the model that I absorbed into my role have had a 3% inflation built into the model. So I give some comfort to the fact that there's some accountability for a worst case scenario on inflation. If it's been running, you probably have it better, Andy, but I believe 2% over 5 years is pretty much what I've heard.
It's below two, and our internal view is it's not going to probably, if it does go above 2, it's going to be short-lived, and we would expect inflation to remain pretty anchored for the foreseeable future. It's kind of a double-edged sword. It's lower national inflation, but also lower returns. It's just a tough environment on the fixed income side. I think it's going to be that way for quite some time if you're a saver. I mean, I'm sure many of you probably have positions in savings accounts and banks and CDs and such. And it's just not a fortuitous environment on that front. It's just there's no way around it. It's there's really just no other way. I think the question today, the main question is this: the question is the group from a long-term perspective is comfortable in obviously repositioning the portfolio where it's going to earn X, which may or may not keep pace with inflation, versus having some exposure, of course, to equities. And then, depending on that answer, is determining if the answer is yes, obviously you move in that direction. If not, you maybe move to more of a middle ground where some of those aforementioned various paths you take, whether it be reducing equity exposure, or maybe even just exposing it to across the yield curve. So versus going short duration, you kind of spread it out and maybe maintain something that's comparable to what you have today as it relates to just being kind of more of a representation of the broad bond market. So the expectation is that longer term, you're rewarded, you're compensated, for that lending of money for lengthier periods of time. So that's the other option you have, is versus going super short in banks and CDs, is you still maintain something that's a bit more representative of the broad bond markets.
Thank you. Any comments to that from my committee? I did just want to clarify one thing, Andrew, to make sure that I understand this. You do not develop any type of risk profile for us. That is our decision on what risk we are willing to take. Is that correct?
So the ultimate decision is yours. Our role, and this is, so we look at our clients and my clients, this is one of our important roles is to be part of that conversation, is providing the tools, one of those being that market model analysis that we kind of talked about. So ultimately, with our clients, and we deal with 1,000 different clients, endowments, foundations, and such, and ultimately, it's their decision. So, for example, if the goal there's a target allocation, through conversation with us, usually a finance committee or board approves that, and it's reviewed annually, kind of like the effort you're going through now. But ultimately, it is going to be your decision. So we're not arbitrarily saying, Sun City West, you need to be 40/60. We are, in conversation with you, you vote and confirm that, and we adhere to that through our management of the portfolio.
Thank you. We do have some board members here. George, I'll start with you. Do you have any questions, comments you want to make?
At this time, no, Ann.
Okay. Mr. Young? Sharon?
No, I'm fine, thanks.
Jerry?
Briefly, if I may, I think Andy suggested an approach for the committee and ultimately the board that might be useful. The idea is based on his understanding and Vanguard's understanding of the economy and where it's going and the advice they can give us. They give this committee a variety of scenarios of risk. There were a number of risk factors that are critical for those scenarios. One was the possible annual gain or loss any given year in 10 years, and the overall result as compared with the inflation rate that might be expected. And with those scenarios, the committee can decide where best they think the association ought to be positioned at this time. That process, I believe, is what the then subcommittee on investment of BNF went through back in 2015 and came up with a risk level or scenario, which then Vanguard translated into particular purchase and allocation. And I believe the 60/40, as I best understood from talking with people back there, was kind of a distillation of what that risk was. And as Andy suggested, can be changed year by year as economics change. So the idea is that, Ann, as you just identified, we being the association, pick the risk level based on the scenarios and advice we get from Vanguard, and they pick the investments that accomplish that. I understand sensitivity towards equities, but I will say this boards for the association have been badly burned when they attempted to give specific investment advice for the reserve fund. And I think the board is going to be a little reluctant to just say, invest here, don't invest there, and leave it rather to Vanguard to implement the risk scenario that you chose to take.
Thank you, Jerry. Does anyone else have any more questions for Andrew while we have him on the phone? Yes, Jim?
It's supposed to be on. Anyway, there we go. Andy, what is the 10-year range risk reward on the investment that we have now? You guys present that to us not every quarter, but every so often. You may have said it, but I have a hard time hearing what you're saying. So would you try to clear that up for me?
Sure. I'm sorry. So that was the risk reward component? Yeah. So I think I'll repeat. I'll try to speak up. So we run the analysis, and you're right. Typically, we don't like to show it every quarter because it doesn't necessarily change much, and also quarter to quarter. And also, the idea here is not to make these kind of knee-jerk reactions to what we're forecasting, because they're just really designed for kind of more expectation setting, and also through these annual conversations that we have as it relates to policy. So just kind of give you broad strokes as it relates to what our best thinking is. I'll start kind of with the broad high level of picture as it relates to the stocks and bonds. So the outlook for stocks is going to be, compared to historic averages, pretty low, I guess I'll use a simple term. So for U.S. equities, our expectation over the next 10 years is about, as a reasonable range of 4 to 6%, which history tells you that 10 or 11 is kind of more average or normal. So we're quite a bit below that. Non-U.S. equities are higher at 7.5 to 9.5% over the next 10 years. And then I mentioned bonds. Bonds, unfortunately, the expectation is just based on the environment is pretty low, about 0.5% to 1.5%. We can then take that and then we drill down into the actual portfolios themselves. So I was mentioning earlier that can translate to a range of returns, a total return at a 40% stock, 60% bond mix. And then we can stress test the portfolio based on various historical events, based on over the next 10 years, what the expectation is of a downside would be. So for example, I shared earlier the likelihood of this portfolio of experiencing a loss in excess of 20% in any one out of the next 10 years is less than 1% likelihood. So it's pretty low that you'd experience a loss in excess of 20. And even this year, if you take a look, I was doing some analysis on your portfolio, and if you do look, I think some of the earlier numbers that were shared looked at the March 23rd low when the portfolio hit its low for the year. But when we present returns, it's typically month end. So through the end of March, just to kind of give you an idea of maybe some of the rationale of why the portfolio was selected early on, we obviously experienced a pretty unique time in the markets, historical to say the least, as it relates to the severity and the swiftness of the downturn in the market. So I pulled up your March report, and so from January 1 through March 31, the portfolio was down about 9% for that period. So even under the most, we'll say, stressed environment, and I guess you could arguably say there aren't many times we were experienced, granted you go back to the great financial crisis, but that took quite a bit longer to hit the depths that it hit. Same thing with the tech bubble. It still didn't happen over a 16-day period. So, and then even back to other periods, whether it be 1987 or 1973, 74, I mean, this was unique to it. So you could definitely make the case this is a very, it's what they call an outlier, something that you don't really necessarily see very often or expect to see. That even in this really horrific environment, the portfolio for the year through the end of March was down about 9%, which is not great, but you take a look at exposure and the risk and the downside is the portfolio still did what we would hope to do, that the bonds were actually acting as that ballast and actually positive contributors to returns. In addition to that, let me find my, there we go. So I'm going to pull up the, all right, so these are maximum drawdowns. So the other thing that we can analyze from a risk perspective is the likelihood of experiencing a downturn. So markets inevitably go down. I mean, even the time you've been with us, if you think back, for those of you that have been on the board or the committee, we had periods, at least 2 or 3 periods, where markets were down in excess of 10%. You think back to Brexit back in 2016. You think back in the last 3 years, we actually had, even in December of last year, if you think back to what happened in the marketplace, where the S&P was off just almost 20% for that period. So we've experienced these things. I think what's happened here is this has been very unique, but our expectation for maximum drawdown for this type of portfolio, so that's from a high of a portfolio to a relative low, is about 8%. So the expectation is that what's normal as a drawdown in this portfolio at any given year in the next 10 years would be about 8%. So even in the most stressed environment like we've seen this year, you kind of fell kind of within within that range of drawdown.
That answer your question, Jim?
as best as I can hear it.
Anything else? Yes.
Madam Chairman, I have a follow-up question for Andrew. Andrew, in your professional opinion, do you regard our 60% fixed, 40% equity split to be consistent with our policy, which says preservation of capital, number one, with what I would say characterize quotation mark, small growth or some growth? Summary. Are we consistent?
Yeah, it certainly, I think it's, I would tell you that we view this as a bit more conservative in nature in, let's say, the hierarchy of our client base. And granted, we have a pretty wide breadth of different clients, and no one is the same. And I think this is where you have to be very careful in comparing yourself to what averages, because ultimately, you're as a group, and you want to manage towards that. I would say, as it relates to preservation of principal, once again, this kind of goes back to my initial comments, as we view risk from a couple of different vantage points. One is the risk of the loss or the downside of the portfolio, and the risk of not exposing the portfolio to enough or presenting enough growth to the portfolio, where you're taking too conservative a stance. So, factoring those two into the equation, from our vantage point, I wouldn't say that you're being aggressive or negligent. I guess the group needs to really come to the decision if there is a determination that some degree of equity exposure to create some reasonable long-term growth expectations is appropriate. The question is 40 right? Is 40% stock exposure right? I would say that if I'm getting the feel that there's certainly an underlying concern there, that the next move is to reducing the equity exposure, whether it be to 30 or 20%. If you were to reduce it to that portion, I would say you're probably closer aligned. If you want to think about those three goals in the truest sense, where there's zero or little appetite for any sort of decline, moving that dial, the needle down to 30 or 20% stocks would probably accomplish that. So I guess that's the best way I could answer the question, is that I think in any given year, it may not adhere to that number one goal of preservation of principal. Dialing down the stocks would get you much closer there. Doesn't eliminate it, but it definitely does align it. And it does also address the other concern of this inflation risk. So the fact that you're not going to expose the portfolio to enough growth potential, so you feel safe and secure about the principal, but based upon your spending needs and the investment return, that you're not keeping pace long term with reasonable returns and inflation. So I guess that's the best way I could answer the question.
I appreciate you taking an attempt to answer a very difficult question. My takeaway from this, and if you would comment on my takeaway so I can make any adjustments I need to in my own personal model, it's a little bit of the beauty is in the eye of the beholder when it comes to defining preservation of capital in a portfolio.
You probably put it more succinctly than I did. I think you need to de-risk from not just. I granted it's very important to look at the downside. I think March obviously was kind of the catalyst that kind of brought us here today. It could have happened honestly after we started the relationship. I mean, what happened if this happened in the first month of the portfolio? So part of this is the timing as well, which is always not ideal. I mean, the good news is obviously you've built up enough of appreciation or base appreciation where you were able to withstand this and still not really delve, although you got, I think, pretty close to back to where you were square one. But you have certainly, a buffer, I guess you'd call it that. I would agree. So, I mean, speaking just generally as it relates to designing and implementing portfolios, we would be hesitant, just generally speaking, to tell a client to go strictly to cash if it is a long-term horizon. I think you have competing thoughts here. We have obviously a plan in place that is putting preservation principle top first and foremost. I think in most clients' portfolio, in policy statements, that it is definitely embedded in many regards, in many policies. You tend to find this is included, and there still is equity exposure because the other concern is, of course, not allowing the portfolio to grow at at least with inflation when you factor the money that you're drawing out. So I don't think it's uncommon. I think what's probably unique here is that, I think there's consideration is should you have any equities. I think for most conversations is not if you should have any equities, it's how many or how much equity you should have. This is unique in a sense where we typically don't have conversations. Does it go from 40 to 0? So I think that's pretty unique.
Thank you, Andrew. Any other comments? Anybody questions for Andrew or comments they want to make while we still have him on the line? Hearing none, Andrew, thank you so much for your insight for us today and bearing with our questions and trying to give us short answers to what I know were very complex questions. So we thank you very much.
Happy to do it, and happy to continue the conversation. We'll be in touch, and let me know if I can need any further help.
We will do. Well, that put several items on the buffet, didn't it? It did. We will now move on to policies FI04 and FI12. Now, you have a copy of FI12 in front of you, which is blue-lined, and it adds 3.1.2.3, which we discussed at our last BNF meeting. This statement is that funds shall be invested in a range of 60% fixed income and 40% equity. This was an insertion required because this was approved by the board in June of 2015. It was never added to the policy. So all this has done is just bring us up to where we are and what should have been in the policy all along. So that is part of FI12. FI12 is also the policy that, as we just saw, states that preservation of capital is the foremost objective of the investment portfolio. And that we would consider things like credit risk, interest rate risk, and market risk. So we want preservation of capital, then we want liquidity, and then we want rate of return. Those are in that order. That is what's currently in the policy. We also have policy FI04 that says, let me find it here, that we will have an association standard for an acceptable reserves is set between 40 and 100%. And that was approved by the board just this last spring. And Pete, we are at what right now? Just so I am perfect, I'm talking with good.
Roughly the low 50s.
We're currently in the low 50s, okay. And of course, the two words we want to always avoid for our owner members are special assessment. I think all of us will agree, as owner members, we do not want to hear that. So we've got to take an approach with this of, first of all, I'd like to hear from my committee, do you think our goals are in sync with each other? Lisa?
Anne, can you come back to me, because I haven't read this completely.
Okay. Harry?
Well, as I stated earlier, I you know, my goal, I don't think we should be at 40% in equities. I think it should be a lower figure. Whether it's zero or not, I don't know. But I've always believed that everybody should have some skin in the game. And the way to put the skin in the game for the people that have been here 20 years, 10 years, or 2 years is that a portion of our membership dues goes to the preservation of assets, period. And everybody understands that. I don't think a select group like the APF fees should be, all the newbies should have to pay all the expense. I think that's wrong, because the people that have been here for 20 years have used the facilities, have wore the facilities out, and they should be paying all the way along.
Harry, I appreciate where you're going with the designating something every year for that, but if we're taking something out of the, and immediately saying that, then if we have a shortfall somewhere else, we could have an issue. So what I'm asking right now is, do you think our policies are going to allow us to do what they say we should do? Can we preserve capital, keeping the split at 60-40, and also keep the 40% seal or floor on our reserve funds?
Well, the 40% floor, I agree with. I mean, it should be higher, but it should never go below 40%. I agree to that. Now, the other 40%, equities, I think that should be looked at and addressed. But you're going to have to figure out another income source.
I understand that. Lou, do you think these policies should stand because they will complement each other, or do we need to address them?
I think the policies, as approved, we are consistent currently with addressing and fulfilling those policies. Do I think the policy is wrong in that the spread between equities and bonds should be changed? I have any number of questions. What is the current rate of return on equity bonds and CDs? What is that dollar amount? What's that delta? I think you have to do best case, worst case scenario, as Andrew was talking about. Looking at that rate of return, projected rate of return, what's our downside? And I think John talked about it. And I think we just have to do, a complete analysis, sit down with Pete and try to figure out what's best. And it's all downside. I mean, it's really not upside. Upside's always great, but the downside is what kills you. So we need to look at it and, then make a recommendation to the governing board to adjust that ratio. Maybe the ratio's 80-20 instead of 60-40. The other question I have is, what's the process? Does the is it required that the governing board vote on this change?
Yes,
If that's the case, can Mr. Schwinn go to the governing board and say, we know it's going to, it's got to be advertised, et cetera, and there are some timeframes involved here. Maybe he recommends to the governing board that you immediately move to a lower beta ratio with the current funds that we have. According to Andrew, the interest rates are going to be low for the foreseeable future. I've been looking at the VIX, the volatility index, and that's just out of sight. Nobody really knows. So I have a lot of questions. At this point, I would say, as the policy is written, we're consistent with the policy. Does the policy need to be changed? I would say it needs to be talked about and, based upon analysis, should be changed.
So what policy would you change, though? Would you change the 40 to 100% range for fully funded balance? Would you change preservation of capital as our primary objective, or would you change the 60-40 split?
60-40 split.
Okay, so you would change that one.
Right. I think the preservation of assets and funds is paramount.
Okay.
Certainly,
That's,
right.
these are the three things, though, that
Right.
can't always,
It's always risk
may or
reward.
may not gel.
Right.
You know,
It's risk reward.
yes, very much. Terry?
I agree with the goals and objectives in the list. It seems to be contradicting the 60-40 split. So, like you said, I think it just needs to be looked at, as Lou said.
The 60-40 needs to be looked at?
Yeah.
Okay. John?
Excuse me. I agree with, primarily agree with all the things that Lou said, and I'm not going to try to repeat them. They were well stated. To directly answer your question, I feel based on the evidence presented so far, I feel like policy on the FI 12 2.1.3 needs to be seriously looked at and considered, as well as 3.1.2.3, which is the 60-40. I feel there's enough evidence been presented today to seriously question those, and I think as rich as this discussion has been, and as eye-opening as it has been, I still feel like we need more data, which I believe was one of Lou's suggestions. I would like to see the data in a more comparable format where I could get my head around it a little bit more and define in my mind the risk-reward. Because based on what's presented so far, I see a great deal more risk than reward when you put it on a per-member basis. You're not talking about a lot of money. If I could take $30 a year and write a check to somebody and say I had no risk whatsoever for anything, I think I'd seriously consider that. But I really need to see the data to make an informed, fact-based judgment.
And if I may, Ann,
Yes.
I'm over, Lou's over here.
Oh, Lou. I thought, for some reason, I thought I was Pete. Yes, Lou.
I don't know if anyone else would like to do this, but I would be happy to be on a subcommittee, maybe to work with Pete and come up with, I think Kathy said earlier, you know, sort of a condensed sort of thing to say, this is where we're at, this is where we may go, present maybe 3 or 4 different scenarios. So I'd be happy to work with Pete and anybody else. So to really get some, for my own self-edification, to get a little more clarity.
And to educate the committee, too.
Right. Yeah, correct.
Any takers to work with Lou?
You're it, Lou. Tag.
Lou?
Sure.
Okay.
I appreciate that.
You won't be a subcommittee of one.
I would be glad to join him if you need somebody,
Okay.
Although perhaps Kathy would want to do that instead.
Okay. Kathy, let's hear from you.
I absolutely agree that the order of preservation of capital, liquidity, rate of return is proper in that. The rate of return does not, the current rate of return does not line up with preservation of capital. And that's what this discussion has been all morning. Second, I agree on 3.1.2.3 as a policy, that has not been written in the current policy. It is what exists today. As much as I, in my gut, say we shouldn't approve this, we should, because that's where it is today, and that we're going to have to take an action after that, would be my opinion.
Well, we're not even,
Or we table it.
we're not even voting to approve 3.1.2.3
Oh,
because
okay.
it's been done.
Oh,
It's-
okay.
we-
It's just a correction. Got it.
Yes, we addressed this at our last BNF meeting, and it will be going to the governing board.
Yeah, I'm okay with that. I'm okay with that.
On Thursday. So what we can do, I mean, we could vote to take it out
Yeah.
and not even have a range of funds. We could amend it to say something like, this will be reviewed annually, or, you know, the funds will be invested at the board's discretion. You know, there are just lots of things that can be
Right.
done there. But we're not voting to
Right.
add it because
Okay.
it's
All
in,
right, I'm
it's
fine with
there.
that. I don't
Yeah.
have any problem with that. I do agree, the more conservative approach is appropriate, but I don't think we can make it a conservative approach without looking at the impact on revenues and where that shortfall would come from. So I don't see it as clean as making a decision here and then figuring out over here. I see it as a combined decision.
Sure. Thank you very much. Lisa?
No, I absolutely agree with everything that Lou said, and I appreciate the fact that he is stepping up to do a subcommittee, so thank you, Lou, and then Pete. I look forward to seeing what they come up with, and I agree that the 60/40, that 40 absolutely has to be looked at and either go away or significantly reduced. Thank you.
Thank you. Well,
And if I may, just a quick comment on what I've heard thus far.
yes,
We, as the financial team perspective, to Pete's and his staff, we've listened to Andrew, we've had many conversations with him. He repeated it today for your benefit. But the one thing I think that may help us take next step, if I may, relative to the board or board decision, when it comes to moving this decision to plant and I don't have the numbers in front of me, I apologize, but the decision on the 60/40 scenario that was approved 5 years ago into the policy. We see that in talking with Andrew and our staff, we see the way that sentence is written is a little binding, whereas the decision is 60/40. We would like to maybe render an opinion here that the BNF committee may want to consider today in moving this thing forward, is that we just simply create a few words in that sentence that basically allow the situation to move forward, but put a limit on the equities not to exceed 40%. And then that would give the governing board, financial advisors, or who else we consult with down the road, that if we want to adjust that to a 90/10, to an 80/20, to a 70/30, like Andrew's recommending, that we have in policy, we have the ability to do that. So instead of locking us into a 60/40, give us an opportunity to wiggle, if need be.
if I'm hearing you right, Bill, then 3.1.2.3 might read something like, funds shall be invested in a range of fixed income and equities, with equities not to exceed 40% of the total.
Yes, ma'am.
Does everybody understand that?
And then we can come back
This
later
would-
with the data and everything else that Lou and John and the subcommittee want to deal with as far as future recommendations as to whether they want to mess with equities at all or do whatever. That can come at a later date. But as far as just moving this particular item on the agenda forward, I think a not to exceed 40 on the equity side may get us there, because that gives us the opportunity to negotiate with Vanguard on perhaps a less exposure on our principal.
Okay? Let me try to reiterate what's that, Lisa? Oh, go right ahead.
Bill, I just have a question. Does that mean that if we go ahead and insert that in there under 3.1.2.3, that wording, that you're going to then turn around and perhaps reduce this 40% equities?
That would give this committee and the governing board an opportunity to do so,
Okay.
because it would be
But
in
prior
policy.
Prior to Lou and Pete,
Negative.
no, you wouldn't do anything?
I wouldn't recommend it. I think what's going forward to the governing board on Thursday, I believe, is this particular recommendation regarding the 60/40.
We can make a change here today that will just say, it's not going to change the ratio right now. It's just going to say that 40 is our ceiling for investment in equities. Then we can see what John and Lou come back with for us and discuss it further, and then make a recommendation to the board of how we want to proceed. Does that, I want to reiterate again what I wrote down to make sure that everybody understands. 3.1.2.3 would read, funds shall be invested in a range of fixed income and equities, with equities not to exceed 40% of total investments. So let's.
Ann, would you say that again, please? This is,
Oh,
am I to understand that this is the new wordage for 3123?
yes,
Recommended.
recommended
Okay.
to go to the board. This will just allow us to move further with this, Lou, after you and John have an opportunity to meet with Pete and come back to us with more information. We're not.
Just say the words again.
Okay. Funds shall be invested in a range of fixed income and equities, with equities not to exceed 40% of total investments.
Okay.
Now,
so move.
That doesn't lock us into a 60/40. It doesn't say we're going out of equities or we're going to, whatever split it is. This just gives a ceiling for the equities. And you're good? Okay. Let's just go around and see who has any more discussion on this, and then we'll vote on this. Terry?
No, I'm good.
John?
No comment.
Kathy? Lou? Harry? Lisa?
I'm good.
Okay, so do we have a consensus of our committee to move this forward to the governing board on Thursday as a red line item?
Yes.
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 Thank you all very much. And from this discussion, I'm now going to create I'm going to call this an investment subcommittee. That will be the name of it. And, yes. All righty. Who's got a suggestion of a name for?
John's committee? No.
How about an FI-12 subcommittee? I think that would be just fine. FI-12 subcommittee, and that will be John and Lou. I mean, with Pete, yeah. But is there anyone else from the Budget and Finance Committee who would like to work on this with John and Lou? Okay. We need to have, based on the rules of subcommittees, we need to have a delivery date for recommendations. I'm wondering if 2 weeks from today, November 3rd, is too quickly to have at least a preliminary response.
John, I don't know about your availability. I'm good on Thursdays. As a matter of fact, this coming Thursday, I don't know what Pete's availability is, but the 22nd and the 29th, I'm available. I don't know about you.
If I can tell you, they're both booked at 11 a.m. with me on the subcommittee meeting,
On the
22nd.
on the 22nd. Well, what about, I mean, you're booked at 11. Are there other times, Pete, you're available on the 22nd?
Available, as she said, the morning is covered. Afternoon, and
What's
I'm
your,
pretty sure the 29th is wide open.
well, I'd like to do something on the, I mean, if
The afternoon
if
of
we
the
meet on the
22nd.
29th, the deliverable on the 3rd is,
True.
you know, pretty close. The afternoon of the
Yep.
22nd is good for me. John?
In any Thursdays work quite well for me, except 11 o'clock this Thursday.
You want to do?
Madam Chair?
It's fine.
You probably want to have lunch, Pete. 1 o'clock?
Fine, you bet. Thank you.
Okay.
Okay.
Now, what's the name of this committee?
This is the FI-12 Subcommittee.
FI-12.
And you can meet in the governing board conference room if you'd like to.
I would like
There's plenty of room to space out in there, space out physically, I don't mean mentally on that one. The other thing is, I would like to have any kind of recommendations that you will be bringing forward. I would need to have those by, let's see, Karen, we have to publish for the agenda. When will I need to have those? Okay, so probably by end of the day on the 29th, so that we can have that redlined, if there's something to redline in the policy, to have on the 30th, because we'll put the agenda out for the meeting on the 3rd.
So we will have by end of day on the 29th, details to Ann. And then you can deal with it from there?
If you're going to be making changes to the policy for the committee to review, yes.
To be honest with you, although I'm quite the optimist, I'm sure we will not have any changes to the policy.
Well, I'm just saying, if you do, I wanted to get that, and then I will put the three of you on the agenda for the November 3rd meeting.
I think we would need to be, and John, yeah, thanks. I think we need to be on the agenda for a presentation.
Yes.
I don't think, and then, of course, board discussion, and then possibly changes to policy. But I think at the November 3rd meeting, I would just request that there be a short time slot for us to provide the committee our analyses.
Sure. Sure. Just, I mean, if all you have to do is give an update, but at least we will keep it in the focus of the committee, and so we'll have something to hear from you guys.
Yeah, so I'm not having a deliverable on the 29th, just so you know.
Probably not, yeah. But, you know, one never knows, Lou.
I am an optimist, but not that much of an optimist.
I appreciate that. Do I have any other comments about FI 04 and 012 as we've discussed so far? Kathy?
None.
John?
None.
Terry? Lisa?
None.
Harry? Lou?
None.
Okay. Have we gotten any comments or questions from our online audience? No. Okay. Wow. Do I have any comments or questions from any of the board members who are here? Sharon?
Sorry, in my reading of the past of what's been done, they used to, sorry. I forgot. There was a risk level assessment that was done yearly in the past. Is that something that should be in the policies at all? So that we are someone is looking at this on a yearly basis as a risk analysis?
Vanguard does not do a risk analysis
I
for
meant,
us each
I
year.
meant the Budget and Finance Committee did it in the past.
That has not, I don't know when that was last done.
That's what I'm asking though, is so that we didn't get to this position, is there any chance that that might be just to have something that you had on a yearly basis so that you knew whether or not it needed to be changed?
That's a good question. I'll take that, see what we can do with that.
It's more work.
Anyone else?
And if I may, I think it might fit well under 4.2.1, where we talks about the annual review of market strategy and risk assessment. Because I think, as we saw from Andrew, the level of risk that the association is willing to take will depend upon a lot of external factors as well as internal, and they change. So the idea of an annual assessment of the risk level is appropriate, and thus the board can give appropriate instructions to Vanguard.
Thank you. It does say that the investments shall be monitored by the BNF, but it doesn't say, I have not seen anything, annual review of investment strategy, yes. So, thank you. Any other questions, comment? Yes, Jim?
Yeah, I'd like to make a couple comments. Number one, I agree with Lou. Yeah, I don't know, this thing don't work. Does it? If I talk into it? If I yell?
Yeah, it's
No,
working.
don't yell.
This train is moving pretty fast. It took the Budget and Finance Committee and the governing board almost 3 years to develop this policy and the procedure to invest funds. We studied several companies, not just Vanguard. We had 6 of them in here for interviews. We did an elaborate much of work in order to come up with this. And I see this train rolling right over the top of it so fast, it can't slow down. And I really appreciate Lou and your comments about studying it, because this thing needs a lot more studying before you do it. And here's the reason, another reason. We haven't even talked about where you're going to put your money that's safe. There isn't any place. You want to put it in CDs. Well, first of all, you've got $3 million worth of CDs. So what did we do? Last year, somebody came to me, as I was the board of the BNF, and they says, we're at risk because we're not following the policy. Because it says that the funds should be FDIC approved. And we put that in the policy. Why? Because it was a protection so that we didn't go out and put $25 million in CDs and lose every damn dime of it. You're not going to lose just 1% of it. You're going to lose it all if it goes bad.
You got it in equities.
And that does happen, folks. I talked to my broker last week, and I said, do you do this? He said, yes, I have one city that I do this for. I do $8 million. It takes me 3 months to find somebody to do it with, and I've had to lose money, but it's all FDIC approved, everything we do. So if you're going to consider this, Lou, put that back on the agenda and check that and see why we removed it, because we shouldn't. If we're going to invest our money in CDs, they should be guaranteed. That's what this policy says. Protection. Well, that isn't very good protection, so please study that.
Okay. Any other questions, comments? Yes, George?
Madam Chairman, I just want to thank the committee for listening to the presentation of the General Manager and CFO put together, and for your advice and comments moving forward. One of the things the governing board absolutely needs is to make sure that we are on the right path. And I think the committee has given us the light of where we need to go. I just want to thank each one of the members for that. Thank you.
Well, hearing no other comments and no comments from our audience, I will adjourn the meeting. Our next meeting date is on November 3rd in Palm Ridge Summit A at 9 o'clock.
Yeah.
Meeting is adjourned.